general liability, workers' compensation, auto liability. You've done all the hoops that you need to make sure that the regulated coverages of auto liability and workers' compensation are properly put into the captive. Regulators are good, and then so you're good to go. Except if you're like Alsco, um, most of your contracts require that you have insurance and not only have insurance, but have certain level of insurance, and not only certain level of insurance, but from certain insurance carriers and with specific AM Best ratings. And the cost of getting that rating, especially if you're a captive, is prohibitive. It's just something you would make the captive not worth doing. And so I guess we just can't form a captive, at least not a captive for those coverages because of our contractual requirements. Well, there is a workaround, and that's what that will be. We're talking about the fronting program. Um, so to the people that you are contracting with, to the other people interested in you having certain insurance, they will look at the policy and they will see it's on XYZ admitted insurance carriers paper. It'll be a name that they recognize, they trust, and nobody will know the difference that you have a captive that's actually paying the losses when they occur. But of course, that's not a free service. That is something that, and there is some risk that we'll talk about to the fronting company. So the fronting programs are widely used by business seeking to retain and manage their own risks by complying with legal, regulatory, and contractual obligations that require coverage from highly rated and admitted insurance companies. And like I said, for us, it's thousands of contracts have that type of wording in it. For regulated lines of coverage, such as workers' compensation, auto liability, jurisdictions require policies be issued by domestic admitted carriers. So there are laws that say this is what you have to do. Additionally, when legislation mandates financial responsibility for losses, an admitted carrier is necessary. Plus, to address this challenge, the organization establishes fronting programs to leverage an admitted carrier's rating and compliance while maintaining control over their risk management strategy. So a captive is a fantastic risk finance tool, but it may be, depending on how you plan on using it, a tool that has to work with another admitted carrier. If you're going to use it for any insurance where admitted carrier is needed, then you're going to have a fronting company, unless you're so gigantic that your captive can go get their own admitted status, which I suspect there are captives that big, but that's not reality. Typical fronting program, an organization selects a licensed and financially rated primary carrier to act as a fronting carrier and policy issuer. The organization's captive services as the reinsurer, assuming the risk for policies issued on its behalf. Generally, the fronting carrier cedes 100% of the losses to the captive, but may retain a portion of the risk premium in some cases. The organization may pay premiums to the fronting carrier to cover any expected losses. Now, yes, that's typical that there's 100%, but it's also common that the fronting carrier, they're in the risk business, will also take a layer of the risk. That's a way to help increase their profits, and of course that's what they're in for. And it's also helpful to the captive that doesn't want to take on the extra risk that might be involved. So the fronting company captive information still going. The general public, they see the admitted carrier and the insurance carrier. So where do they see it? They'll see it on the certificates of insurance. Often the claims adjusters will be from the fronting company. Safety services sometimes will be more from the fronting company. All the services that are available can be obtained by the captive, depending on what they want. But the fronting company does have some credit risk, some significant credit risk if the captive is barely solvent, which hopefully would not be the case. They take on the risk because if the captive goes under, if the captive cannot pay, they're still on the hook because it's the coverage is on their paper, and so they would have to pay. So they often require collateral. I'm told that the collateral is less than the collateral that's required on large deductibles, less in the sense that you don't have to have it fully collateralized, the loss picks like typical with the large deductible. Although for good financials, companies like Alsco that have good financials, they can cut into the cost of the collateral, the letter of credit, and get discounts because of their finances. But fronting company may negotiate some risk as part of the losses. They may 100% cede it to the captive or some combination, but they still will have some credit risk. All right. You basically you've got the fronting carrier and the insurance captive, and insurance captive buys other reinsurance. The fronting carrier pays the losses and then bills the insurance captive. The insurance owner, company owners are paying the fees and the premiums, depending on what layer, to the fronting carrier. It's very simple concept. You simply, for a fee, hire the insurance carrier, the admitted carrier, to write up the policies and take care of the claims usually, although you can negotiate that. You may have your own TPA in certain situations. So what are some more of the risks and challenges? Both the captive and the fronting company face administrative complexity. And it just sounds complex when you're trying to show the insurer being the fronting company, when in fact it's the behind the scenes that's really taking on the risk. So there's some complexity that is a challenge, and that complexity is to both. Of course, there's the credit risk that we talked about for the fronting company, the organization captive complexity of fronting arrangement, the risk of failing to comply with unique terms and reporting requirements of each of the multiple insurers can result in claims and delays and partnerships that are broken up and not happy, and all sorts of negative things. The complexity risk, though, as things become more common, as the companies do it more often, like any other complexity, it will minimize over time. All right, another knowledge check. Let's see what we know. Read the scenarios and respond to the prompt. Okay, the big three chose to exit SROA. Remember, that's the SPA insurance pool, not the swimming pool, pool, and establish an offshore captive insurance company, Verum Agua Assurance Company Ltd., in Bermuda to provide their general liability and workers' compensation coverage. However, since many of their spas operate in large shopping malls, property owners and managers require insurance to be admitted carriers with minimum financial strength and ratings from the agencies like AM Best, Moody's, Fitch, or Standard & Poor's. As a Bermuda-based entity, Verum Aqua Assurance Ltd. is not an admitted insurer in the United States and lacks a financial rating due to the substantial cost of obtaining that rating. Describe how the big three can comply with state workers' compensation, proof of coverage requirements, and fulfill the lease obligations set by mall owners and managers. Additionally, explain the mechanics of this arrangement and how it ensures compliance with both regulatory and contractual demands. It's a mouthful, and there's some possible answers, and we'll go over those. So the big three and Verum Agua would identify a licensed admitted carrier with at least the minimum acceptable rating and negotiate a fronting agreement with the carrier. So there's plenty of carriers that do this, and it's mostly risk-free money. So I think that they're anxious to do it. The fronting carrier retains little or no risk and maintains regulatory compliance. The Verum Agua becomes a reinsurer to the front and retains a specific amount of loss per occurrence. 100% is common of the loss below the aggregate stop loss. Invest the reserve funds and accumulate surplus from the underwriting profit and investment income. Verum Agua may secure reinsurance from other reinsurers to pay losses in excess of a per occurrence limit and losses in excess of the aggregate stop loss. As an aggregate stop loss, the fronting company issues a policy, certificates of coverage, and pays claims with reimbursement from Verum Agua. The reinsurer fronting fee pays the fronting carrier for their services and the use of their name, license, and reputation. So that's where we're going to go with Verum Agua. We're going to use a fronting company, and those are some of the steps that we need to use to get into that situation where we can still operate in our malls and be compliant with contractual regulations, and also with the state and our workers' compensation coverages, auto liability also. All right, development process of a captive. How does these things get formed? Loud and proud. Describe the 4 steps in captive development and explain how regulatory, financial, operational considerations influence each step. So here we go. What are the steps? So surprisingly enough, the steps to form captive, there's only 4, and they're basically the same no matter which type of captive you form. There are clearly some operational differences when forming a group captive compared to a pure captive, compared to a rent-a-captive, compared to a risk retention group. But surprisingly, the 4 steps are very similar, and they are. You do a feasibility determination. Once you've done that and it looks like it's feasible and you want to go forward, you need to select a domicile, because you've got to find the regulator. And so that's becomes an important step, because that will determine specifically what needs to be done on the third step, which is application. Each domicile, each regulator has similar but different applications because they emphasize a lot of the same, but also some different things in their approach to captives. And there's becoming more and more domiciles and regulators. And then fourth, forming and funding the actual business of insurance business of a captive. So we'll talk about the feasibility. Start with, so when I started at MTC, one of the things I found in my office was a feasibility study, a comprehensive, well done, professionally done feasibility study for a captive. And it was a pretty recent one. It was within 6 months of when I started, and it was very positive. I took the time to read through, and it was pretty lengthy. And basically it said, this is a great candidate, this MTC, for a captive. It would, it had the pro forma financial statements that showed that it would be profitable after 1 year, which is pretty quick, and it would, best I could tell, really significantly reduce the total cost of risk. So I grabbed that feasibility study and went to our CFO and said, why aren't we doing this? You spent a lot of money to have this study done. And it turned out that the Department of Labor, which Job Corps went 50% of MTC's business, only wanted work comp to be on a standard commercial. And the reason is they didn't want any type of assessments that may be due in future years. Once a contract ended with Job Corps, they wanted it to be no lingering money. And while there were some workarounds and possibilities, the Department of Labor just said no. They said, nope, we're not going to allow you to use a captive for anything that has to do with Job Corps, which of course that's half the business. It wasn't, they decided it wasn't worth it for just the prison half of the business, that it needed to be the whole company, or it was just borderline on whether it would be worth it. And this is a big deal that needs to be long-term thought through to create a captive. So I found out at MTC that they had looked into it, but they just couldn't do it because of the Department of Labor. I can tell you the rest of the story, as Paul Harvey used to say. In fact, I just had lunch with my replacement there at MTC. We're good friends, and they decided and somehow got permission from the Department of Labor to form a captive just over a year ago. And he reports to me that it's been very successful. He gave me some of the ideas that what he's doing, using it for. They just added a health stop loss to the captive, and they have some plans for some other things. He specifically mentioned cyber that may be coming up and may not be. They may just leave it the way it is for now and try to build up the surplus or I think owner's equity, if you will. So that's my one experience. And now Alsco, as Rich knows, because I have tapped into Rich and all the other faculty members for the CRM financing of risk. We are interested. My boss, who's the CFO, he's also one of the family. He's the 5th generation owner here, so he's the one that's really in control. It says, yes, I'll listen to it. I've done 2 presentations to him. He gives me the yes, I think in the future that's going to work. This is a huge long-term commitment, especially capital, and we are in a mode of acquisitions, and we don't want to tie up our capital and even with the pro formas that we've developed, it looks like we probably lose money the first year and then start turning it around the second year. And that's typical. In fact, that's quicker than typical. We look like a strong candidate. But I did learn, and this is one of the reasons I hesitated, that it's not just my boss who's wanting to wait till they're in a better position capital-wise. Not that we're in a bad position, is that in the late 1970s, when there was first opportunities to form captives, Alsco, with a kind of a sister company, formed a captive. It was specifically one for workers' compensation, general liability, auto liability, and it was designed specifically because there was a tax advantage. They used it to reinsure those lines of business for several years, and then the Tax Reform Act of 1985 was passed, and so in 1986 they decided to just shut down the operations of the captive, and it lay dormant for 20, 30 years. There was some cost, there were some lingering claims, but mostly it just sat there. And finally, I think it was 8 years ago, they divested. There was a company that buys up dormant captives and ended up selling it then. So there is a interesting distaste in the mouth of some of the board members for captives, because it was specifically obeying the laws of the time. The laws changed and it made it not profitable. There's also another side story, is they partnered with the partnership with the company they did it with has gone sour. It was a family, kind of like cousins company, but they sold out to another competitor, and so there's a few hard feelings and just not an appetite to rush into doing a captive again. Although I think I've got my boss convinced it would be, at least in the long run, the right thing to do. Okay, so developing a captive. TCOR is a great analysis tool. It's a way to measure what your cost of risk is before a captive, after a captive, and it will capture the things that would matter, so that you can compare them pretty favorably. So the analysis for TCOR, you want to analyze historical losses, obviously, and exposure data, and put them into today's dollars, if you will. You want to look into the retention selection, and depending on what type of captive, but in the process, that's what you have to decide. You actuarially project losses. Most regulators, I suspect all regulators, require a professional actuarial study, just because even if you can do it on your own, and I think a lot of people are smart enough and have enough knowledge to, having an independent actuary, I think, just fits better, especially from regulatory standpoint. You get your estimated expenses, you get projected losses, which will be the biggest part of TCOR, depending on your specific case, but usually lines of coverage you want, capital structure, what's required by the regulators, and what makes sense for your particular organization. And you put this together, looking forward to what will go into the captive. And it's there's so many different directions that you could go, that you need to have some type of advice from people that are into this business on what makes sense in your situation. I've done that. I've gone to captive management companies that are willing to talk to me, I think with the hope of getting business, but I always make it clear, I know I'm just shameless person to try to get information from my people that I think are smart. And just like the faculty at for the CRM faculty, people really are happy to share their knowledge. Risk management professionals, especially blue collar ones, are just the salt of the earth, and they help make our communities better places to live, work, and play. And then we'll move on to the domicile selection. This is surprisingly important. I would have not guessed it to be as important as it is, but everything I read, you want to make sure that the captive domicile is the right one. Selecting captives can be established either onshore within the United States or offshore outside the United States, depending on various strategic, regulatory, and financial considerations. Just over 1/2 of the states allow captives. That is kind of a new phenomenon, that there's many states that are now welcoming themselves as a domicile for a captive. There's many considerations. It used to be clearly advantageous to be offshore. Now it seems to be, depending on the type of captive, not as important. If you're going to do a rent a captive, that does have to be offshore still, but that's, the others can be either way. Okay, so top captives right now, if you go by volume, number 1 is Vermont in the United States, recognized as a top global domicile and a leader in the U.S., specializing in diverse, complex risks for large corporations. Vermont has been in the lead, at least in the U.S., I feel like forever. Second is Cayman Islands. This was right now is the top ranked offshore domicile, second largest globally, right behind Vermont, known for specialized insurance, reinsurance, and healthcare captives. Then third is Bermuda. Bermuda used to be, and it used to be significantly the largest. It remains a very viable option. It has all the technical necessary services available. It's particularly good for large, complex international risks, and it is one that when and if ALSCO definitely decides to go into captive, it's one that we're considering, not because it looks good for the one we start, because we're going to start with just North America, but when we want to add the full company, the foreign, there may be some advantages to the Bermuda option. And then there's Guernsey. Guernsey is one of the Channel Islands off the English Channel. It's near the French coast. It's self-governing, but it is under the British Crown. And so it's kind of an independent part of the United Kingdom that has their own local government and has been friendly to captives, forming captives as a popular domicile. And then coming up, these are up and coming, Utah and Arizona in the U.S., significant experience, strong growth, and captive formation. Of course, I'm a little bit prejudiced. I think Utah is a great choice. Like I can walk from my office here to the regulator for the Utah captives in 5 minutes. And I have made that walk. We're friends, so it would be a natural choice. But like I said, we're into it enough to know that there may be advantages with offshore, in long term, and you have to think long term when you're thinking captive. All right, so these are outdated, but here's some other popular domiciles. You can see that Vermont leads. This is 5 years ago. And Utah's second. Delaware has dropped off a little bit, but that's not dropped off. It's Arizona has jumped up there. This graph shows you, and this is dated. Bermuda was number one, Cayman Islands number two, and Vermont number three. And I can't remember the date on it, but it shows that there is a significant concentration of where captives are domiciled. But remember that more states are joining. They're competing now with each other, and who knows where the future will be, and who knows, well, there are consulting services that can help you decide based on your needs which these regulators would be best service to you. So while domiciles are to a large degree similar, there are enough differences that analysis should be done before choosing a domicile. We don't want to blindly choose Utah because I can walk and talk to the regulator. However, there is some value, no doubt, in that kind of ease of connection. So our current thinking is Utah, but it could be a Bermuda in the future. And we want to, when we do, and I keep saying we will, it has not been totally confirmed, but the indication are yes, it just is going to take more time than I would personally want. So the capital requirements are a big deal. So some examples is, let's just go through this fake example. Let's say in domicile A, the minimum capital requirement is $250,000 in cash, which is feasible under Jubilee, and Jubilee is the one who's doing the captive, their budget. In domicile B, the requirement is $1 million in cash, making a less attractive option, obviously, for Jubilee. Domicile C provides flexibility by allowing Jubilee to meet the requirements with the $50,000 cash deposit and a promissory note, easing the initial financial strain, which when you're jumping into a captive, that's, that the cash deposit is a huge consideration because it's an expense that's nowhere else until you form the captive. And then conversely, domicile D insists that the entire amount be being deposited in the cash only, and making it a stricter and less appealing choice. So after reviewing the options, Jubilee decides domicile C's flexibility aligns with the company's financial strategy. Now, if it was that clear cut, yes, that would be a nice, easy decision for Jubilee. I suspect, not having done it yet, but when we actually jump into it, it won't be that clear cut. So we got the capital requirements, and then we've got surplus requirements. Surplus, think policyholder, no, think the owner's equity would be the term that you're probably more familiar with. So surplus or policyholder surplus is analogous to retained earnings. Initially, the capital infusion generally requires capital funding to be split into two accounts, capital and a paid-in capital. In addition, additional infusion of cash meant to act as a pre-fund for retained earnings until the insurance operation is generating its own earnings. So it's there's some startup costs in surplus, startup costs in capital that have to be considered, and that is when I say they usually takes a few years before they turn a profit. A profit's not the right word, but before they start adding to the surplus, to the policyholder surplus. Investment requirements. Investments, a significant consideration when forming a captive. Cash flow is an advantage that, and more freedom to invest, the greater the possible advantage. So with regulators, with insurance companies, there's investments that are allowed, investments that are not allowed, and they require a certain amount of conservatism because they want to make sure that an insurance company isn't going out there and buying junk bonds and finding out there's no value to them when they need to go pay a claim. It's not quite that drastic, but that's the idea. And domiciles are flexible with some of the investment choices, remembering that it's not society at risk, it's the owners typically at risk. And so there's a little more leniency on where they can invest and what they may invest in. But there are requirements, some conservative requirements with all regulators. Regulators have to toe that balance. They want to be user-friendly for the captive owners, but they also want a reputation of when the captive is domiciled in their domicile that it's worth doing business with, and it's not some shaky something else. All right, so then there's the investment requirements, then there's reserving requirements. Basically, all regulators require clear loss predictions, and that be done by outside actuaries. And then you need to have reserves that are adequate based on those actuarial studies. So you've got the requirements for reserving, you've got the requirements for investing, you've got the requirements for capital, you've got the best requirements for surplus. And after all those things, you're still building the infrastructure, local service infrastructure, and IRS doing business rule. So what is the IRS? This is actually defined doing business rule. The IRS defines doing business at a trade or business as an activity conducted with a consistent profit motive involving regular, active, and continuous efforts. Key indicators include maintaining detailed records, operating in a professional manner, and turning a profit in 3 of the last 5 years. So the IRS has this rule that when you say you're doing business, you really need to be doing business. You can't be losing money every year to avoid taxes because the money's going somewhere else. It's the typical IRS being the IRS, knowing that there's just temptation to try to avoid taxes that if they're not vigilant on, could happen. It's human nature again. So continuing on the doing business rule, strict interpretation of these restrictions suggests that all insurance-related business, including issuing certificates of insurance, must be conducted offshore. Beyond the federal tax implications, conducting offshore insurance activities onshore could be subject to captive and to state insurance regulators, potentially leading to claims of unauthorized insurance business, creating tax and legal issues. There are a bunch of rules, mostly around the IRS, mostly around taxes that we just need to be aware of and need to hire the right people to help manage the complexity of. And we're going to talk a little bit more about taxes, but it was overtly the reason that ALSCO formed a captive, because they had regulation or rules that allowed taxes to be avoided legally, but they of course shut that loophole, which we're not the only ones that had captives formed specifically to help avoid taxes. Okay, how about meeting requirements? All domiciles mandate a minimum number of meetings for a company's governing body, typically requiring at least one to be held at the domicile. That may explain some of the beautiful domiciles. That might explain the Cayman, Bermuda, Hawaii, and such. But you know, there's parts of Vermont, if you go in the summer, that are beautiful. There's parts of Utah that you go, depending on if you're a skier or not, depending on what time of year, that are beautiful. So not necessarily have to be exotic, but meeting requirements are something that should be considered. First off, the number of meetings, type of meetings, and if there is a restriction that they be at the domicile. And then if they have to be at the domicile, the transportation to be able to get to the domicile needs to be considered. And one consideration that when you're looking for domiciles, the ease of travel, and it's an important consideration. Geographic convenience and cost considerations play a significant role in the domicile selection. If you're trying to get the board meetings, the people that need to attend these meetings together, it's nice to be at some type of local hub for some of the airlines, depending on where people are coming from. And it's nice that you can get to the meeting, get out of the meeting without spending 2 or 3 days in travel, which may be the case on some of the more exotic places. So exotic place may be a motivator, but I suspect just as often geographic convenience is the motivator. And then you've got to, have we mentioned that taxes are important? You got your tax fees and license costs. In this context, taxation refers to premium tax, not income tax. Generally, there is no premium tax levied except on businesses written in the state of the domicile. So if Alsco were to set up in Vermont, because we don't have any locations in Vermont, we would probably not have to worry about premium taxes. If we were to set up in Utah, because we have a couple different 3 laundry facilities here, uniform facilities, and our corporate headquarters, there would be some more than most places other than our bigger locations like California, Texas, and Florida. This would be maybe enough that it would be part of the consideration of domiciling in Utah, although the numbers, you know, are really small compared to the big picture. And then you have to always consider permitted business lines. While some domiciles restrict certain lines, others allow greater flexibility. So depending on what you're looking to get out of your captive, it's important to know if it's allowed in the domicile. Domicile may require minimal capital, be easy to do business with, but if they don't allow the coverage that you want, the basic purpose of your captive, then it's probably not the place you want to be, and you need to know that ahead of time. Statutory requirements are regulated for regulated lines such as workers' compensation, employers' liability, auto liability, have to mesh with the domicile's requirements and with the state requirements of the domicile. It can't be avoiding the workers' compensation statutory rules because you've got a captive. No, if you have to obey the rules of that specific state. And what about political? How does that fit in? So the political climate is something that you do need to consider. Political climate has 2 key aspects: the overall political stability of the domicile. So you don't want to go somewhere, if Guernsey, and it's not, so don't misunderstand that, if they were having some political problems because they're self-governed and it's a small place, you probably want to avoid it. I don't know that there's any on the domicile list that we've looked at that would be considered trouble spots in the world. Um, it may be helpful to look at recent trends in taxes for the domicile. State that's very strapped for money may be looking for ways to tax captives as they try to attract them. That's something to consider politically. But basically, with American politics, a captive is not political. Think of it this way. You've got Vermont, one of the bluest of blue states, as number one. You've got Utah, one of the reddest of red states, number two. And then you've got Arizona, that is very purple, number three. Looks like political considerations are not a big deal, at least the political climate right now in the United States. There doesn't seem to be one view over the other that would be something that would be a major consideration on choosing a domicile. It looks like the choices are apolitical, if you will. Ed and Rich, it looks like we're top of the hour here. Probably be a good time for a break. So be back in 10 minutes. Thanks, everybody. Okay. If you can indicate whether you can see and hear me, we'll move on. Ah, yes. And you're awake. Fantastic. Well, we're on the final stretch, literally on the final stretch, the last hour, and you're hanging with me. You're definitely going to be people that help make our communities better places to live, work, and play through good risk management. I want to start off this last hour with some more quotes from Rich's book, and then some thoughts for you. In the United States, nearly 10% of all employments are involved in a significant to a significant degree in the insurance business, either directly employed by an insurance company or by an insurance sales organization, or indirectly through providing services to insurance companies and insurance sales organizations. In a listing of people's perceptions of occupations, workers in the field of insurance perennially rank near the bottom, usually bracketed by used car sales people above and politicians below. Insurance people are commonly perceived as annoying or dishonest, even on good day. Yet studies conducted by insurance people and surveys in which the respondents are insurance people suggest that the insurance people are honest in their dealings with the general public and each other. And as people in the risk management, we know that with a few sad exceptions, that is absolutely true. But we do have that perception to work with, and maybe we can do something about it. So if next time you're at a social gathering, you're at your class reunion, you're some other business uh, gathering, and you know what you do. You walk around, you meet somebody, they say, "Hey, what do you do for work?" Now, instead of quietly saying insurance, say, "I make our communities better places to live, work, and play, and this is done by one, helping prevent losses." That's what insurance companies do. That's what risk management is. Helping, number two, helping to pay for losses when they do occur. You know, you see those auto accidents, and the vast majority of those accidents have insurance involved and to pay for those losses. Number three, helping boost the economy through investments. You know, insurance companies have piles of money. They don't just put it under a mattress, they invest it into the economy. And number four, supporting credit. You can tell your friend, your new met friend, saying, you know, you wouldn't be in your house if it wasn't for the ability to buy homeowners insurance. There's not a lender that'll give you a mortgage without that protection. And then number five, we are supporting the health and wellness by reducing anxiety throughout society, by helping people sleep at night, knowing that if their house burns down, they have insurance to cover the loss. So we have discussed the domicile, the selection for a captive. Now we're going to move into the third step, the application. And there it is. Okay, so the application, once the feasibility is determined and the captive has been established into the proper domicile, and the domicile will have a specific application that is needed to be licensed in that location. You've got basically four steps within this development process of a captive. When you're trying to fill out your application, you select the service providers. You need to have those as part of the application. You prepare a business plan that has to be added to the application. You meet with the regulators, and then you submit the application. Remember, basically your risk finance team needs to be with you. You need to have an actuary, not physically with you, but you need their actuarial report. You need the financial statements, both the owners owning financial statements, but also the pro forma statements for the captive, because they want both of those on firm footing. And so uh, you turn in the application that's required for the specific domicile that you went through all that careful analysis to select. And then the final step, develop a process of a captive. So this is where you're forming and funding. This is where you put money in the bank. You make the bank account. This is where you secure management long-term commitment for the captive. I disagree. I think that should have been done first and foremost, because a captive is forming a company, it's forming an insurance company, and inherently insurance companies have to be thought of as long-term, because what do insurance companies do? They collect money now for losses in the future, and sometimes losses that have very long tails. In case of workers' compensation, it can be lifetime medical. So you can't go into a captive other than maybe a rent-a-captive with anything other than a mindset of this is long-term. We're not testing the waters. We've tested the waters. We've decided that this is really what we want and what we need to do. And as long as we've been accepted, as long as we've set up the accounts, we've set up our board, we've set up everything, and it's all funded, we are well on our way. So I mentioned pro forma statements. These are just financial statements that with the estimated losses, with the business prospect parts of the application, indicate what the company will look like. Currently, this is a captive company, and in the future, as long as we are relatively accurate on our loss picks, etc. So we'll talk about financial statements. Financial statements, remember, this is specifically an insurance company, are drawn up under accounting system referred to as statutory accounting, or statutory accounting principles, are regulatory accounting principles, if you will. The focus of statutory regulatory oversight is an insurance company is always on solvency and liquidity, especially normal, but even with the captive regulation, to enhance the ability of the insurance company to pay their claims and remain in business for the benefit of policyholders. Consequently, regulation and recognition of assets and liabilities are generally geared towards liquidity and solvency. Similarly, recognition of income is geared to immediate recognition of most expenses and drawn out recognition of premium income. So even with captives, they still have statutory accounting requirements that, while may not be as strict as for commercial insurance, they still have the same general type of goals. So if the conservative thinks that there's certain assets that are admitted that you can put on your balance sheet, and then there's and these are things, obvious things, things that are highly liquid, cash, of course, anything that can be converted to cash in the short term, letters of credit and capital investments, some of them are all permitted by the domicile. Then the liabilities are a mix of short and long-term obligations. Short-term obligations, similar to those ordinary business enterprise, consist of payables, expense that have incurred but not yet been paid, income tax payable, etc. These are all part of the regulatory requirements, the statutory accounting requirements, even for a captive. So capital, there's the contributed capital, there's paid in capital, and there's earned surplus. They will all be considered assets, and and available immediately, if you will, that they are also going to be clearly on your performance statements. Non-admitted assets, this is a category where there may be admitted assets that are admitted under um, normal accounting rules, but not statutory accounting. And that's because they are geared towards liquidity, geared towards conservative finances, so that some assets just are not allowed as far as on your performance statements. Reconciliation of financial statements, purpose of financial reporting on behalf of the owner and the policy owner, a statement that reconciles the difference treatment between income, expenses, assets, liabilities drawn up and converted to statutory accounting. Values that the GAAP is generally accepted accounting principles. And so you're dealing with two different systems, but primarily it's the statutory when you're talking about a captive, because a captive is an insurance company. All right, let's do a knowledge check. Read the scenario and answer the questions. The remaining 9 pool members of Spa and Resort Operators Association, SROA, are very concerned about the pool's viability now that the big 3 have exited the pool and formed their own captive. They learned that the big 3 have formed a captive and asked you, their consultant, which type of captive they should consider. What do you recommend? So now you've got these 9 small members of this old pool kind of distraught because the 3 big ones had left, formed a captive, and so they come to you, risk professional, and said, what should we do? What would you recommend? There's a lot of potential answers. You could say you're too small, don't worry about it. Get rid of your pool so you get rid of the liabilities. But here is a better and an acceptable answer for you. Since the association only has 9 members, it is not a good candidate for a single parent captive. They're too small. The captive funding and administrative requirements would be too onerous. The same is true of an association captive. The organization is not large enough to support its own captive. They would consider, they could, I should say, consider a group captive that's already formed. They find a homogeneous group, all pool or spa operators whose premium structure, underwriting guidelines, and service meet their needs. The exposures would be similar. If a rent-a-captive is available, that may be the best choice. Insureds can directly control the underwriting of their own risks, as in a typical captive. The losses of one insured are isolated or segregated, if you will, rather than shared with all the others in the rent-a-captive group. It's commonly used by an organization that desires more control over their destiny, but is not willing to risk the capital commitment and requirements of a pure captive or expose themselves to a financial vicissitudes of an organization which has no control. So there is a potential answer for that knowledge check. All right. Finite risk insurance. So out of all the programs that you've gone through, I have had some experience in the guaranteed cost, small deductible, large deductible, retro programs, self-insurance programs, my experience with pools, and experience with captives, although it's still in the development of a captive stage. I have not had finite risk insurance exposure other than with and we'll talk about, there's a couple different types of finite risk insurance, but the one um, I am familiar with and have used, personally used, is a loss portfolio transfer. And we'll talk about what that's, how that works here in a minute. Okay, so loud and proud. Describe the characteristics, types of finite risk insurance contracts and the circumstances in which such financing is appropriate. Sadly, we're on the home stretch. The second to last objective is, will be just fun. That's all I can say. We're just having fun. All right. Finite risk plans. The best way is just to read through this stuff, because it's a way different than what maybe you're expecting. It was way different for me, just not because it's unusual, but because it's outside of my personal experience. So finite risk insurance refers to a range of loss financing strategies that integrate internal and external risk financing while involving traditional insurers in a non-traditional way. So it's usually done by contracts with insurance companies. Also known as financial insurance, it is termed finite because it functions similarly to a high-level loss retention program. These programs typically require that the full annual aggregate expected losses be funded during the policy term, being the financial meaning the financial commitment is both finite in time and amount. So finite risk insurance is commonly utilized by organizations facing unique risks that the traditional insurance market deems unacceptable. These programs are typically used for high severity, low frequency exposures where traditional insurance is either unavailable or prohibitively expensive. So the examples would be high limit earthquake coverage in an earthquake zone. And we are facing that, ourselves. We have California locations, Alaska location, Utah locations, Washington, New Zealand. We've suffered an earthquake loss there. Fortunately, it wasn't one that shut us down or anything. All right, so liability coverage for environmental risk is, I think, probably the most common, the one that I think could come up on any property owner. One of the key benefits of finite risk insurance is its ability to mitigate the financial impact of catastrophic losses on an organization's financial statement. So if you're, especially if you're looking to divest of something anytime soon. So this is probably the best way to try to learn this stuff. So you got the category of insurable versus uninsurable. For traditional insurance, we know what it is. Lots of members that can put in premium to pay for a few losses. With finite risk, it expands insurability by covering nearly any risk, provided that there's a reasonable quantification. It can be quantified in over some type of extended period. Annual versus multi-year. Traditional insurance is mostly annual. I've had 2-year policies. Our crime policy is a 3-year policy, but basic policies are almost always annual. With finite risk, they are typically 5 to 10 years. And the indication is that closer to 10 is the norm. So they're dramatically different on time frames of the policy. Spread of risk. Risk is spread across many insureds for traditional insurance. Spread of risk for finite insurance applies only to one insured, eliminating traditional risk distribution. The extended time frame and structured funding strategies offset the lack of spread of risk. Time value of money. There's important considerations with time value of money for traditional insurance, but it's not a big deal. It's usually the insurance carrier that has the premiums that invest, but it is a huge deal with finite risk. Investments, earnings on premiums, because we're putting lots of money into to these accounts we'll talk about soon, there is going to be investment earnings, and where they go and who and how much people get is an important consideration. All right, so there's retrospective and prospective finite risk. Retrospective, this is it covers events that have already happened. So let me just tell you, lost portfolio transfer. That's probably the easiest way to go. This is one type of retrospective finite risk. This is where the time that I used this, when I was at MTC, I, unknowns to me, I got this big package of losses, and it was a invoice that we had owed some money. I had no idea what it was for. It wasn't a whole lot of money, but it was significant. And like I said, I had a whole stack of losses. Fortunately, and this is a shout out to all brokers, agents. My broker agent was able to explain that this was an update on a retrospective plan that we had in California years ago, and there was a significant amount of still open claims, and they were still below the maximum on the retro. It was really impossible to know exactly how much that was going to cost and for how long it was going to cost. It did not have a commutation clause in the policy. So after paying the retro bill invoice the first year, when it came the second year, the CFO said, "I don't care what it costs, get rid of it." We ended up finding an insurance company that would buy the risk or sell the risk. I don't know how you'd put it, but we paid them to take over the risk of that retro. I'm sure we paid 2, maybe 3 times what they ended up paying on it. I don't have that as a proof, but it was a way to get rid of that annoying invoice every year. So that was one example of using a lost portfolio transfer. I found out that Alsco, when they divested of their dormant captive, that they had to buy a type of a lost portfolio transfer to transfer any liability that was left in that captive to that third party. And I don't think they paid a lot, because I think the evidence was that there's really nothing there. But the buyers of the captive would not take it over without that lost portfolio transfer being in place. Prospective are high limit catastrophic catastrophe type losses that haven't occurred, and they may not ever occur, but they could, and it's a real risk to the organization. So common features of finite risk insurance contract. Finite, so there's these 8 elements: experience account, commutation, policy terms, cancellation, insurer compensation, risk transfer and taxes, credit risk, and interest rate risk. These are all parts of the finite risk contract. So an experience account, in this case, think of a savings account. You're going to put money into this. We're funding the premium. Up front and into an account that has certain restrictions. If the account is to pay losses, the account will, because it's a lot of money typically, have investment income, and it has to be decided how that would be distributed between the insurer and the insured. And then it has to include things like the policy term, when it's going to end. That's the experience account. The commutation is a provision that allows for distribution of if there's a positive balance, the insured can cancel the policy at any time. The insurer cannot. Policy term is typically multi-year. 10 years is common. Cancellation, the insurance company can't cancel, but the insured can. as long as there's money in the account. If it's in a deficit, they still have to pay into it. And we'll see a little bit how that works. The insurer cannot cancel the policy even if the insured fails to pay an annual premium. Insurer compensation, unlike traditional insurance where profits come from underwriting, because they're taking on risk, the finite risk insurance is guaranteed a certain amount and is predetermined, maybe 5 to 25% premium of the potential loss limit, and the insured earns some risk-free interest. So basically, they say whatever the treasury bond is, that's what the insured gets. Above that is the insurer, typically on the compensation. Risk transfer and taxes. IRS generally doesn't like these because there doesn't seem to be really a transfer of risk, not a true transfer of risk. It's more of a savings program in case something bad happens. That's depends on how it's set up. It can be, since these are all manuscript policies, it can maybe qualify and maybe not qualify for deductibility per IRS, considering a true risk transfer. Their credit risk, the insurer faces credit risk because if the premium is paid over the period of time, if the down payment is made, but the other payments during the multi-year can't be paid, that's a credit risk to the insurer. Interest rate risk, if the interest rate is lower than expected, lower than the T-bill, there's actually going to be no, that's very unlikely, but there would be no interest investment amounts made, and so there'd be no income from the investments if there is the interest rate risk. I think really the only way to get a grasp of this is to jump into this example. It's a lot easier than trying to read the words and deciding. So here we go. Delta something, a national fraternity, anticipates a wave of claims related to the past hazing and misconduct incidents. To manage potential financial exposures, the fraternity opts for a finite risk insurance contract. Delta hires GDI actuarial consultants to assess potential damage based on the limited number of known and settled claims. GDI projects a liability of $250 million over the next decade. Since the past events are not covered by existing insurance, the policy and former insurer are no longer in business, and they're no longer in business. Alternative risk financing is necessary. So here's what they decide, and they establish. The limits are the full expected losses, $250 million. The term is 10 years. Annual premium is $25 million. Insurer fee is 10%. Interest rate is 2%, and that's based off treasury bill, perhaps. The late in the 10th year, so it's gone 10 years, late in the 10th year, in a class action suit against Delta, a settlement was reached in a class action against Delta, and the insurance carrier paid $150 million in claims. All right, so read the scenario below, answer the questions. So here we go. How much money will Delta receive when the contract commutation and calculation is completed at the end of the 10th year? And what risks are taken during the 10-year period by both Delta and the insurance carrier? So here's the numbers. Total premiums, 250 million expected losses, less the insurance fee, which was the 25 now I'm drawing a blank. Less the total fee, which was 25 225 million, so 25 million. I can't remember exactly where that came from. Let's move on. Plus investment income, so 2%, the equals 5 million, 230 million less, less the settlement of the class action suit of the 150,000. You do all the math, the balance to delta becomes 80 million. So they pay a premium of 250 million. There's a settlement of 150 million, and they'll get back 80 million because of the other costs involved. This is obviously a unrealistic example, but it does show you the steps that are taken with this type of finite risk. All right, what risks were taken during the 10-year period by both Delta and the insurance carrier? And this should be a little easier to understand. Okay, risk taken by Delta. Damages greater than 250 million plus expenses. If that was the premium, that was the potential expectation. So that's pretty significant risk. Challenges to tax deductibility of the annual $25 million premium, and then ongoing reputational risk. So those are the risks taken by Delta. What are the risks taken by the insurer? Risk taken by the insurer, credit risk of Delta defaulting on the annual premium. Remember, it was 10 years of paying 25 million each year, or losses exceeding the premium payments, and interest rate risk if the spread between the actual investment and the income and the present preset risk-free interest used in the commutation is less than the spread between the assumed investment and the income. So it's an interest rate risk that the insurer takes as a part of their compensation. Okay, you probably haven't heard us in this risk finance arena talk anything about taxes. They don't, they're just, you just never hear about it. Wrong. Okay, so our final learning objective, if this button would work. Voila, loud and proud. Explain the collaboration between the risk manager and the tax manager in developing a strategic and effective risk financing plan. Okay, I already mentioned it. One of the advantages of having a risk finance team collaborate and talk with each other was the day that I had lunch with our tax manager and found out that we were doing our taxes, our billing to Canada wrong from a tax point of view, that we were able to save some money because she knew what we were paying and how that we could more properly pay it. Also with the tax manager, and I'm not sure exactly how this is used, but when she found out what was contained in our statement of values for our property coverage, every year she loves the fact that she gets a copy of that and she uses it on some tax tax stuff that she does. I wish I could tell you better than that, but it was because there was collaboration. It's because a couple members of the risk finance team were talking together, and because taxes are such an important part of of the risk financing from a lot of different points of view, regulatory being one of the main ones. So there, find the word. Risk management initiatives can significantly impact tax decisions. And likewise, tax decisions can influence risk management strategies. For an effective risk financing plan, ongoing coordination between the risk management and tax management team is crucial. So just as a side note, I did talk to our tax manager, mentioning the fact that we were looking at perhaps creating a captive. And she let me know in no uncertain terms that that was a tax person's nightmare, that the captive, she said, we would have to hire outside tax help if that's what we're going to do it. She knew that her team, as good as they are, did not have the expertise. And she, to her credit, after she told me how really bad taxes are when it comes to captives, said actually she knew of a tax consultant that specialized in captives and typically worked for reasonable rates, and somebody that she trusted knew. So while she personally ran from the idea of captive for tax reasons, she did have contacts that who knows, we may use sometime in the future. So risk finance.
Wendell?
Yes, sir.
Yeah, before you continue on, we have a number of people that are a little panicky because this learning objective is not in the learning guide.
Oh.
So folks, this is a freebie. You just get some information and you're not responsible for it. Somebody just said, no panic, just a question. Well,
I would panic.
Like people, yeah, Wendell would, so would I. So what Wendell's talking about now will absolutely not be on the exam. It's just, it was dropped from, we had a big discussion that we keep saying we're not, taxes so specialized. Risk managers never make those decisions. It's always somebody else that makes that. And finally, I won the argument that we shouldn't really dwell on it, taxes, because risk managers don't do it. So it got dropped from the most recent version of the learning guide. So don't panic, folks. This is just a freebie. Just you're getting a perspective that you don't have to worry about. Okay.
So okay, does this mean that I may have didn't have the latest PowerPoint, or that just hadn't been purged from PowerPoint yet?
I think you have the previous one.
Okay. I'll have to double check. I thought this was the newest one, but
no, that's okay.
Not. Yeah.
And
okay.
Everything in it is right up to this isn't in the learning guide. So all the other stuff is good. So
okay, so we are saved by Rich as far as these tax information, and he's one of the few people that might understand it. He's a doctor in accounting something or other. So thanks, Rich, for looking out for the blue collar risk managers out there. Appreciate it. What we'll do then is we'll just read through these slides on tax and then conclude. We'll do a quick summary and conclude. All right, so risk financing and taxation. My notes on this are nothing, so let's just read through it. The risk manager uses information provided by tax management department to assess and quantify the potential risk, which makes it possible for risk manager and tax manager to collaborate on a series of cost-benefit analysis to weigh the financial alternatives. The risk manager must then analyze qualitative non-financial issues that might arise in program selection, such as whether the choice will impact goodwill and public opinion, etc. The goal is to assess and design a program which best fits and supports the organization's objectives and risk tolerance using collaborative approach. So the subjective ideas of mission, vision, objectives, risk tolerance, risk appetite still have to be considered, even when we're just talking about coordination with the tax people. Okay, so factors affecting risk management decision making. Although risk financing options may not change dramatically from the year to year, tax regulations often do. We all know that there are bills in Congress every year that affect tax laws. It's I think it's a real boon for accountants and for tax software makers. I know TurboTax probably loves it. I love that TurboTax incorporates all those things, and I don't have to try to go find them myself. But I wish it wasn't so complicated. Risk managers often seek private letter ruling, PLR. If they can get a private letter, this is official document from the IRS explaining how some complex matters will be handled, and then it's certainly a protection if you have that letter and the IRS tries to interpret it differently. Some risk financing decisions involve long-term commitments. Forming a captive is a great example of a long-term commitment. Joining a pool, less so, but still, depending on how the pool is set up, and of course, a risk finance, a finite risk plan definitely is a financing decision, and tax implications may shift over time. When you're talking about long-term, 10 years for the finite risk policies, while risk managers maintain control over financing decisions, they cannot control tax regulations and may ultimately affect the plan overall effectiveness. Consequently, continuous collaboration between risk management and the tax professionals is essential. Remember, it was a change in tax laws that basically, I can't say destroyed, but made the captive that, ALSCO was on the cutting edge when captives were just becoming an option. But it was shot down within a couple of years by legislature and tax legislation. All right, so factors affecting risk management decision making. We're going to move on to key considerations for risk and tax coordination. All right, there's FAST 113 compliance. FAST stands for Financial Accounting Standards, and this 113 establishes criteria for tax deductibility of risk transfers. This is a decision by the Financial Accounting Standards, and they like to call it the 10 to 10 rule. This rule requires that at least a 10% chance that losses will exceed 110% of the premium contribution. Failure to meet this criteria may compromise tax deductibility of premium. So if you're deducting premiums as business expense, they have to be real premiums, is what they're saying. It has to include real risk transfer. Multiple tax systems discussions of taxation typically focus on federal income taxes. However, state and local tax systems may treat some transactions differently, requiring consideration during the decision making. Each of these pile on to the fact that we really need more expertise. In fact, I'm going to do this. These are the tax. We'll go through. Let's do the summary, and then I have a couple quick stories. The insurance industry operates in cyclical markets. The fluctuation between hard and soft conditions that impact coverage, policy terms, and pricing. To navigate these shifts, organizations often adapt alternative risk financing strategies, which provides stability, improved claim control, and better budgeting. These strategies reduce reliance on annual insurance cycles, enabling businesses to proactively manage risks based on their specific exposures rather than on market trends. By integrating an alternative risk financing strategies conducted through feasibility studies and ensuring collaboration between risk and tax teams, organizations can develop stable, flexible, and customized insurance solutions to align with their financial objectives and risk tolerance. So the fact that you people are out there, thank you for being out there, learning about risk management, reminding ourselves of what we already knew about risk management, helps make our communities better places to live, work, and play. But one problem that can happen, we become complacent. We are the smart ones. We're the ones who did the CRM classes, and we think that we're doing everything right, so we don't need to be as vigilant as maybe we should be. So a couple stories. I'm with the risk manager at a prison in Ohio, and we've been walking around there all day. We went to the vocational shops. We went to the kitchen where it no longer bothered me to see inmates with knives in their hands. I'd just gotten used to it. And we're walking across the field, and we see a group of inmates together. And I think nothing of it. I'm already pretty complacent about where I'm at. Well, the risk manager that's with me, who happens to be an ex-Marine, just takes off running. He runs across the field, runs to that group. They started splitting up. He called everybody to get together. And then he said, took their names. I found out that they have a strict rule that no more than 5 people can gather together. This was about 10. They asked him if they were in trouble. He said, only if you do it again. So I'm not sure what the consequences were, but I could see that in prison, getting used to the inmates, you get complacent. Next story, my son, right after 9/11, decided that he was going to join the Marines. He says, Dad, I've joined the Marines. I'm going in the infantry. And I said, son, I'm proud of you, but it's up to you to tell your mother. I'm not going to do it. I get a call from him the next day. He says, Dad, I don't know what to do. I'm at Alphaville with Mom, and she's crying. I go, you're a big Marine. You just figured it out. He had a couple deployments to Iraq, one to Ramadi, which this was after Ramadi had settled down. It wasn't the warring time that happened before. And he was with a group of Marines. They're stationed downtown. Their duty simply is to march the streets using different patterns every day. As they left their apartment, there was a sign above the door that says "Complacency kills," and they would tap that sign as they went out. One of the things that they liked is once in a while they would go on a convoy, and the convoy was different, and that was a good activity. They liked it. My son on the convoys, he was a machine gunner. Well, one day they got on the they got the call for convoy. My son grabs his machine gun, runs in and gets in the Humvee, and then realizes that there's a jam. Now the protocol, what you're supposed to do is when you bring the weapons back, you make sure they're in working condition, and before you take them out, you of the apartment, you make sure they're in working condition. So 2 of the protocols had not been followed, and of course, this is the one time that something happens. There was a roadside bomb that literally blew up the Humvee right behind my son's. He said the 4 Marines inside there lived. I don't quite know how. I saw a picture of it. But when this happens, the normal strategy is to kind of circle up the wagons, because this is usually or often an ambush. And during an ambush, one of your best weapons is a machine gun. And my son realized that they were down one machine gun because he'd gotten complacent. And there he was when it might be needed. Fortunately, it wasn't. But he said that was a lesson that he learned. And when he tapped that sign, the complacency kills, from then on leaving the apartment, it had a whole new meaning to him. And while if we become complacent, it may not have the same life or death consequences that a Marine might have. It still could have very serious consequences, because we may miss an opportunity to to really do something that improves our communities. And remember, we're trying to make them better places to live, work, and play. Thank you for your time. It's great to see people ready to participate. I'll turn it over to Rich.
Thank you, Wendell. Thanks for sharing your, as you call it, blue collar, but oh, my dog is saying goodbye to you also.
Tell him goodbye.
Teddy, you have to behave. Okay, folks, thank you very much for all your cooperation. Okay, I give up. I've got to let him out of the office. I'm sorry. Oh, now my wife is calling for him, and he's conflicted. Oh well. Okay, he'll be quiet. I don't even have anything food to give him. Okay, so thank you again, folks, for picking the Big I in Alabama and the Alliance for Your Educational Needs. Do remember you have, if you're taking the exam, you have to get your proctor selection done. I recommend you finish that up tomorrow. So there's people that can help you at the Alliance if you have a problem. You will get some evaluations. Please finish those and send those in. And if you don't get one in your email, you can track one down on your profile page in your course history. It'll show up there. If you're from one of those 4 states, don't forget you have that affidavit to that should be done pretty quickly. And if you're not if you're not taking the exam, thank you again, and you are dismissed. If you are, we're ready to start the exam review right now. With a few clicks of the button, and we're off and running. Okay, so there are clicks. There's the reminder. It starts. Your exam window opens on Monday, the 16th, closes on Thursday. Don't forget there's St. Patrick's Day in there, and some people get giddy and excited. Factor that into your studying. You know what I mean? Again, this is a reminder of how to get a hold of me if you've got any questions on the course content, anything that was said today or yesterday, and you'd like clarification. Drop me an email or drop me a text, and I'll take care of those things. And this is what you've all been waiting for. That is the breakdown. You can take a screenshot of this, or it will show up on the recording, and it will also show up on, I think you can access it through your profile, but I'm not sure when it gets there. I know it lands on there eventually, but that is the breakdown. So as you can see, it's balanced almost perfectly at 25 points per 2 hours, and 20 questions, fairly evenly, spread between everything. So any last questions? This is your last chance to ask a question. I'm seeing a bunch of no's. Oh, that's went the wrong direction. I'm scrolling looking for questions, so make sure that. Okay. Let's see. They're getting near the end. You guys had a lot of comments that you made. Okay. Oh, okay, a bit confused about the column. Let's see, on this slide. Okay, section 1 was 2 hours. There are 3 questions on the exam covering the first 2 hours. There are 10 subparts, so it's like question 1A, 2A, something like that. The hours, that's how many hours we spent on the material. Exactly. We spent 5 hours talking about alternatives, 4 hours talking about the team, 4 hours talking about, I forget the title of it, but yeah, that's exactly what it is. And the points are, like I said, 12.5 points an hour, 25 points for 2 hours. So last questions, going once, going twice. Ted, thank you for your help today. And folks, we'll see you on the CRM trail somewhere.
Thank you, everybody. Thanks, Rick. All right, I'm going to close her out.
Okay.
Thank you.